Hi, I'm Ninness, your loan pro from Denver, Colorado, with another episode of How Much Mortgage Can I Afford? Today, we're going to be actually diving into part two, if you will, of an episode a couple weeks ago, talking about interest rates and how the note rate and the APR rate are different and why that's important to know as a consumer. So stay tuned for that. As always, if you like the information, make sure you like, subscribe, follow, do what you need to keep receiving this every week, as it is a weekly series. Otherwise, enjoy this episode, How Much Mortgage Can I Afford? Well, thanks again for joining me on another episode of How Much Mortgage Can I Afford? Just 2 episodes ago, I broke down information on what exactly are discount points for a mortgage and whether or not you should be looking at paying them. Now I'm going to break down the differences between a note rate and the APR. Before we talk about the differences on the 2 different types of rates, I figure a little bit of background might shed some color on why there's even 2 different rates that we discuss in the mortgage business and why they may be important. Now, the note rate itself is the rate that your mortgage is going to be accruing interest on per diem, per month, annual basis. So if I said you have a 5% note rate, then you know that the principal balance of your home would be accruing interest at exactly 5% per annum. The reason it's called a note rate is because the document securing financing against the property itself, and that's recorded at the county level, is called the note. It is a legal instrument that is recorded with the deed of trust at the county level. The note is the terms of repayment and includes things like the length, the interest, the payment itself, and the rate, as well as if it were a fixed or an arm loan. The deed of trust is actually a document that is securing the home as an asset for that loan that can be obviously taken away if you don't pay. So take away all the extra documents that are at a closing from various laws and attorneys, and you'll find that these 2 documents are actually the most important for the finalized terms of your financing. So an APR calculation is not only going to be looking at the note rate, but it includes all the costs and fees of getting a loan shown as an interest rate for comparison purposes only. The reality is that your note rate is in fact the note rate. The APR then is purely showing you a percentage to decide how it compares to other lenders and what they're offering. The reason this came out is because rates are advertised by companies at a low note rate, but the APR is higher. The APR is including things like your mortgage insurance rate, the fees of getting the loan, and in many cases, lots of points. So let's say you are comparing 2 lenders with each other on a $400,000 loan, and lender 1 is offering you 4.75%, lender 2 offering you 4.25%. The initial thought for everyone is to take the lower rate, right? Of course, why wouldn't you want the lower rate? But now let's change that to where you're offered 4.75 with total closing costs of $5,000 for lender 1, and your closing costs on that awesome 4.25 are $13,000. Basically the same $5,000, but they added on a 2% discount or points for $8,000. Is it still a good rate? The correct answer is it depends on how long you're planning on being in the home. But for comparison purposes, you can easily get the APR percentage on each offer and compare. There are many instances where the note rate offered is lower for one company over another, but the APR is that between the comparison is actually higher. And the reason is simply because of all the costs. A good example of this is when comparing FHA to conventional loans. Now, it's normal for an interest rate on a conventional loan to be higher than an FHA loan. That's typical. But because the mortgage insurance is sometimes higher than that of the conventional loan, on an FHA it's mandatory, there are many cases that with 5, 10, or 20% down, the note rate is lower on the FHA loan, but the APR on the FHA loan is actually higher. So as a consumer, you want to look at the APR calculation closely, as that's going to give you the best idea of what you're paying as an effective rate. Note rates are absolutely important in the long run, but how much you spend on the entire transaction is always important to a consumer, and the APR is the best option for comparison. So with that, I hope you learned a little bit more about APR rates versus note rates and why they're important. Now, as always, if you have needs for financing, please call, email, or submit a note online at financemedenver.com. We would love to help you with your home purchase. Otherwise, keep watching, learning what you can, and enjoy an episode that'll come out next week. Thanks for watching.